Hi everyone, welcome to today's webinar. Very glad to have you all here today. Our monthly global FX Outlook webinars that we host in the first week of each month. It's related, of course, to our global FX Outlook report. That's in the resources tab of your Zoom controller, so you can download that from the resources tab there on your Zoom controller. Or of course, you can go to the Convera.com website in the blog where you'll see our daily market update, our FX weekly, more tactical, looking at the likely moves and big drivers for the week ahead. And of course, this, the Global FX Outlook, which really helps businesses plan their payments and hedging over the medium to the long term. As I said, thank you very much for joining today. I'm your host, Stephen Dooley, the head of market insights here at Convera, and I'm joined by Shirley Lim, our FX and macro strategist for APAC, who will be covering the forecasts and recent moves in the APAC region. Webinar today will go for about 25 to 30 minutes. We'll have Q&A at the end, so if you've got any questions, please feel free to ask them during the presentation or after. But really appreciate you all being here today. Okay. So let's start off and have a look at what the big moves, the key insights were over the month of February. Well, the US dollar was stronger again. The US dollar index climbed to fresh 3-month highs after that hot inflation data, but reverse course once the dollar index got up to around 105. But looking around, particularly in Asia, you can see the US dollar has been broadly stronger throughout most of the month, and the Aussie dollar, the Kiwi, at recent lows. The euro dropped back to a 3-month low with that US dollar strength, but it managed to recover towards the end of the month. It's around 1-month highs versus the US dollar as we speak at the moment, mainly because investors have pared back the expectations for rate cuts from the ECB from 6 down to 4. Sticky inflation and wage growth that remains increasing is the main reason why markets think the ECB might not have as much room to cut rates in 2024 as perhaps markets thought at the end of the year. And the euro has been stronger again, particularly in Asian markets as well. The British pound has also been stronger, not just stronger, but relatively stable as well. It's actually the second best G10 FX performer for the year, behind the US dollar. UK data has been a bit stronger than market thoughts. And again, the issue we've seen right throughout Europe has been that inflation's been a bit more persistent. Wages growth has remained high, and as a result, markets think that maybe the Bank of England and European Central Bank might not be able to cut rates quite as soon as the Federal Reserve. And then finally, in Australia, Aussie dollar mostly weaker in February as the news flow around China continued to disappoint, falling back down to 13-week lows. The Aussie US is down more than 5% from its peak just there at the end of 2023. Looking at all these markets before we move on to the next slide, this really outlines the theme, the title, what we're focused on at the moment in this webinar. Who's on first? which central bank will cut rates first? And don't want to give the game away early, but really at the moment, it looks like the US might be able to cut rates first. The Euro and UK might not cut rates until maybe the second half of this year. And Australia and New Zealand might be the developed central banks that cut rates last. So this is going to be the story in the first half of this year. Who's on first? Which central bank cuts rates first? And once they do, historically, interest rate cuts have led to a weaker currency. So it might see the US dollar weaken first, the Euro and the UK weaken later, and maybe the Aussie and Kiwi weaken towards the end of the year. But before we go into that, let's have a look at the global economic outlook and what we're focused on this month. Of course, the story for the last 2.5 years, the story that will drive central banks is inflation. And looking here at US inflation, we can see that inflation is really starting to fall. And the theme that we identified in the middle of last year, that goods inflation has fallen faster than any other type of inflation, really does continue. We've talked about this before. It bears repeating that the big driver of inflation in 2020 and 2021 was that massive demand explosion when most of the world was in lockdowns, looking for new furniture, looking for desktop monitors for working from home, looking for Nintendo games to entertain families, exercise equipment. That explosion in demand for goods at a time when supply chains were stressed drove up prices, and that's what drove up inflation. Higher goods prices, higher inflation then flowed through and pushed through into services inflation, haircuts, holidays, dining. So as we went into 2023, goods inflation has collapsed, core inflation has fallen, and we're just waiting to see whether that continues to fall here. And that's going to be the big driver of when central banks are able to cut. But you can see here around a third of the Fed's components are now below the inflation target. Two more really within the target, and then a few more here a little bit above the target. So we expect to see these drift lower, maybe not get back down below the Fed's inflation target, but that's why we expect to see the Federal Reserve having the capacity to cut rates. But for now, certainly in the short term, the Fed will remain higher for longer. That's been that big theme this year as markets have moved back from thinking about 6 rate cuts to 3 rate cuts. But this is the big story at the moment. Inflation is coming down rapidly, and for now, the expectation it will fall further, but these more sticky parts of inflation are remaining resilient. And as I said earlier, the fact that inflation has been more resilient has driven this higher for longer theme. And that's when you can see really this year, interest rate expectations for cuts from around 750 basis points worth of cuts from the Fed, the Bank of England and the ECB, now up to 460. So those expectations have really pared back, and the moderation in those cutting expectations has really been the driver that sent US dollar and global bond yields higher. But what's interesting is that US shares and most other what we call risk assets have really outperformed. And we've seen that up until last night, admittedly, but US shares hitting all-time highs, gold hitting all-time highs, even the cryptocurrency space, Bitcoin making an all-time high last night. Bit of a sudden sell-off towards the end of trade, both in Bitcoin, US shares, and to a lesser extent, gold. But this really does seem to be the major theme, that even though those expectations have pared back, still lots of interest rate cuts priced in, and that's what's driving these very calm financial conditions at the moment. Financial conditions have flipped from being a wind into being a tailwind, and that's what's driving this big move higher in equity markets. And that's what I said. Financial markets have been remarkably calm and have really been remarkably able to make new highs, even as geopolitical uncertainty has pushed up. And so you can see here in black, the movement in political uncertainty has exploded higher. But this green line here is what I was talking about in terms of financial stress, financial conditions becoming more of a tailwind. You can see that these two influences, worries about geopolitics, improved financial conditions, are battling out. And at the moment, clearly those better financial conditions are winning out. So what's the big theme that we're looking at in what we've looked at was February? What's the big theme that we're looking at in March? Well, 2024 has seen a trend reversal, and financial markets have finally accepted that a March rate cut won't appear, and that the Fed remains still some time from cutting rates. So that has been the big shift in 2024 so far. That's caused bond yields to climb, as we say, but particularly it's caused the US dollar to strengthen. So really a clear phase, a shift in January and February. What's going to be interesting is if we see a bit of a shift in that as we get into March. And not to draw too many conclusions from that big sell-off we saw last night, but that might be the first sign of a change in regime, that perhaps markets will start to get a bit more nervous, perhaps around those geopolitical issues, and perhaps that very easy financial conditions that's boosted equity markets might not continue to last. And what's going to be the driver as we flow into this month is, of course, as we said, those central bank decisions around what comes next from the European Central Bank and the Federal Reserve. You can see here the European Central Bank meets on the 7th, that's Thursday, in European time, and that's going to be really quite key. As we mentioned, the euro has pushed higher over the last month. It's at 1 month highs versus the US dollar, and multi-month highs versus other currencies like the Singapore dollar and the Australian dollar. If we see a bit of a confirmation from the ECB, they are thinking about cutting rates, then the euro might weaken. So that's the first big focus that we've got for this month. And the next big focus, of course, no surprise, the US Federal Reserve decision, absolutely key here on the 20th. And remember, we started the year thinking the Fed would cut rates at the March meeting. The financial markets certainly did. If we're unlikely to see the Federal Reserve cut rates at this time, but it certainly will be looking at that statement for any signs about what their view is and when they seem likely to cut. The market still believes the Fed will cut rates 3 times in 2024. And so this is what we'll be looking at from both the ECB and the Federal Reserve, laying the groundwork for Q2. The Federal Reserve has recently reinforced the future path of policy going to depend on incoming data, and that will really be the jobs number that we get at the end of this week, an inflation number later this month. Bank of England, also interest rate cuts are on the horizon, according to the Bank of England. UK data is going to be key. And as we said, the European Central Bank on Thursday this week. Sticky inflation and strong wage pressures remain the main concern, but growth has been very disappointing in the Eurozone, and that is the risk that could see the euro weaker after that rate decision that we get on Thursday. Okay, so that's the setup for the month ahead in terms of macroeconomic events. Let's drill down a little more closely. I'll pass it over to Shirley, and Shirley will look at the APAC currency outlook, and I'll jump back at the end to look at North America. Shirley.
Thank you, Stephen. So let's kick off by discussing the volatility we have seen in the Kiwi. The New Zealand-US dollar pair experienced heightened volatility in February as concerns over a potential global growth slowdown put pressure on the Kiwi against the US dollar. We also saw some significant swings driven by the shifting US bond yields. The Australian dollar didn't want to miss out on the action either. The Aussie-US dollar volatility ticked higher, likely influenced by some disappointing economic data releases from China, a major trading partner. An interesting dynamic emerged between the Australian and Japanese currencies, with diverging monetary policy stances from the RBA and BOJ, generating higher volatility in the Aussie-Japanese yen cross. In contrast, US dollar CNY volatility remained relatively subdued over the period. To summarize, growing concerns around the global growth outlook, especially in key markets like China, appear to have driven higher volatility in some commodity currency pairs. Turning our attention now to currency performance, the Australian dollar has underperformed against most G10 currencies as the global demand outlook has become murkier. The Aussie-US dollar downtrend has been quite pronounced, with the pair trading well below its historical averages from the last 2 and 5 years. In addition to the above-mentioned global demand worries, the Aussie has also faced headwinds from euro strength, which has pressured the Aussie-Euro cross. While recovering oil prices have boosted the Canadian dollar, the Aussie hasn't benefited to the same extent, with Aussie-Canadian dollar also trading below key averages. The broader picture shows the Aussie struggling to find its footing amid this cloudy demand environment. A rebound in global growth could help the currency regain some relative strength. However, the RBA's policy stance will also be a key factor in keeping the Aussie competitive. To summarize, the Australian dollar has underperformed its major peers as the growth outlook has weakened. We'll be closely monitoring economic indicators like commodities and global PMIs to see if the Aussie can reverse course. Moving on to the Australian dollar's performance against the US dollar, it's been quite a roller coaster in recent months. Shifting market expectations around potential Fed rate cuts have triggered significant swings. Earlier in this year, markets were pricing in a high probability of the Fed cutting rates. However, strong economic data then led to a recalibration of those expectations, contributing to the Aussie's decline against the greenback. While the RBA faces challenges in the domestic economy, our analysis suggests that they may be nearing at the end of the tightening cycle. However, we do not expect the RBA will cut rates in 2024, partly due to their policy rate being comparatively less restrictive than some central banks, as well as substantial fiscal stimulus measures scheduled to begin in July, such as your tax cuts. Looking ahead, we do see potential for Aussie to recoup some losses against the US dollar. If the RBA holds rates steady while the Fed eases policy, that could provide a solid boost to the Aussie currency. Factors that could drive Aussie higher include the rebound in China's economy, lifting commodity prices, or the RBA maintaining rates while the Fed continues easing. Next, let's discuss the performance of the New Zealand dollar against the US dollar. The Kiwi has shown resilience against the greenback, which could be attributed to the RBNZ being one of the earlier central banks to initiate its tightening cycle. With the official cash rate currently at notably restrictive levels, there is an expectation that this could eventually weigh on growth and exert downward pressure on the currency in 2024. Additionally, while there has been some progress, New Zealand's current account deficit remains elevated at 7.5% of GDP, with concerns that the income deficit could further widen as interest rates rise. Hence, there are risks to the Kiwi if global growth slows sharply, as that could negatively impact commodity prices and dampen risk appetite, potentially dragging the currency lower. Continuing our discussion, let's talk about the Chinese yuan's performance against the US dollar. Over the last year, the yuan has weakened against the greenback as PBOC has eased its policy stance. Chinese leaders have publicly stated their desire to avoid sharp declines in the yuan's value to prevent destabilizing capital outflows. With China's economy facing challenges and inflation remaining extremely low, the PBOC does have room to potentially cut rates further. However, a sudden heavy depreciation of the yuan could spur volatility in the financial markets, which is unlikely and desirable outcome for the policymakers. Some gradual weakness in the yuan against the dollar appears likely. However, we do not anticipate sharp drops beyond levels that will alarm the PBOC and prompt potential intervention. The PBOC do have tools at its disposal to manage the yuan's value if needed. Ultimately, their focus seems to be more on supporting China's economic recovery while maintaining currency stability. Finally, let's turn our attention to the Singapore dollar. Core inflation in Singapore unexpectedly eased to 3.1% year-on-year in January 2024, down from 3.3% in December 2023. Initial analysis suggests the goods less influenced by Lunar New Year dynamics are still exhibiting price pressures, potentially signaling the businesses are adjusting their pricing strategies less aggressively due to reduced cost pressures or diminished pricing power. Given the heightened frequency of meetings by the mass, they may adjust their policies in response to the significant changes in core inflation forecasts compared to their previous meeting. This could suggest a case for Mars to maintain its current policy stance through the end of the year rather than tightening further. However, Mars has iterated his commitment to remain vigilant, to inflationary risks as highlighted in Budget 2024. And that will be all for this month's APAC Currency Outlook.
Fantastic. Thank you very much, Shirley. That was great update on that APAC region. I'm going to take over now and have a look at what's happening in the North America currency outlook, particularly focused on the US dollar, which has a big impact, of course, on FX markets around the world. And looking at that volatility analysis that we discussed. Perhaps what's more surprising is that where we've seen the most volatility in recent days in the US dollar has actually been with the more safe haven currencies, the dollar Swiss and the dollar Japanese yen. Normally, those currencies tend to outperform during periods of financial market stress, but that hasn't been the case over the last month. As we mentioned, financial markets have been feeling pretty good. So instead, it's really been a case of these carry trades and looking at how those currencies, the Swiss franc and the Japanese yen, relatively low interest rates versus the US dollar. And so some market participants using the Swissy, using the Japanese yen as a funding currency and then putting the money into the US dollar, which has been supported by those high interest rates. So interesting to see that the two currencies versus the US dollar with the most volatility, Swissy and the Japanese yen, both currencies, well, maybe not the Japanese yen, but certainly the Swiss franc, certainly one of the lower volatility currencies. So really driven by that funding process. And it's what you see sometimes during periods of very low volatility, that you see more speculators taking advantage of interest rate differentials in FX markets. And of course, if there's anything we've noted over the last couple of months, that volatility has been remarkably low. The dollar Swissy and the dollar yen standing out there. Otherwise, Shirley already covered the Kiwi and the Aussie, why we've seen some volatility in those markets. And then finally, right down the bottom of the range, interesting to note the dollar CNY, again, Shirley covered, but versus most of the major US dollar markets, does seem that the People's Bank of China are really trying to cap any more Chinese yuan losses, and that's seen the dollar CNY, CNH just really capped, unable to move much above that 723 to 724 level. All right, in terms of where the value presents itself in the US dollar and the North American market here, dollar yen, it's been a theme now for 2 years that the dollar yen has been absolutely redlining in terms of its performance versus moving averages, or versus that's 1 year, 2 year or 5 year average. 24% above its 25% if you round up above its 5-year average. So an incredible move higher, driven by divergence. And it's just a fascinating story because when we talk about why we are interested this month on who's on first, which central bank cuts first, it's because that divergence is what creates volatility in markets. And as I said, we've started off in a very low volatility market, but what's likely to bring volatility back into FX markets is if central banks start to cut at different rates. And at the dollar Japanese yen, if we see the US central bank, the Federal Reserve, cutting rates at a time when the Bank of Japan is raising rates, then we could see this market turn very, very quickly. And of course, as you can see, it's at an elevated peak. Otherwise, the US dollar above the Canadian dollar, that's a growth story. The US economy clearly outperforming in terms of growth versus the Canadian dollar in quite an extreme way. And to the downside, we did already mention the Aussie dollar, the real underperformer. And as I speak at the moment, with the Aussie dollar very close to 65 cents, it's been very rare the Aussie dollar spends much time under 65 cents. Over the last 20 years, less than 3% of its time has been under that 65 cent level. So this is rare territory for the Aussie dollar. Let's have a quick look at what we are looking at. And as I mentioned, the euro recently stronger, up around that 108, 109 level, 1 month highs. And that's been driven by the expectation that maybe the European Central Bank wouldn't cut as quickly as the market thought at the start of the year. So that's what's driven that little rebound in the euro dollar over the last couple of months. But we do see this as relatively near the peak for the euro over the course of this year. The strength of the euro might be almost as good as it gets. You can see the range looking ahead to the year, 110 to the top side, around 106, in this grey area, which is our core expectation for the euro over the course of the year, and that 108 is our target for the end of year. What could drive us higher? If we see a pickup in the global recovery, and by global recovery, we really mean China, Germany, so closely tied to the expectations for Chinese growth. If we see a recovery in China, that can potentially boost Germany and boost the euro as well. On the other hand, if we continue to see the euro struggle, that's why we can see it move back below 106. Of course, the euro US dollar tends to move around about a 15% range each year. So, really looking at that range that we've got here of around 106 to 112 over the next 12 months is actually quite conservative. The pound US is another story where we feel like that potentially the pound's recent strength, you can see where we are now, broadly up around 9-month highs, broadly near 9-month highs around that 128, 130 level. Could be around the top of the range for the year ahead. And again, that comes down to when the Bank of England starts to cut. What could see a bit of a pop up to 130 over the next couple of months is the opportunity if we see the Fed cut before the Bank of England. Again, timing of central bank moves critical for the first half of this year. That could see us move up to 130, but over the course of the year, do expect the pound US to head back lower. And again, we talked about how the US dollar has been so much stronger over the last 12 months because of that growth outperformance. Really comes down to the stimulus that we saw from the the President Biden's administration that really pushed a lot of cash into the US. Of course, the US economy a lot more dynamic. And then lastly, some of those moves in US stock markets driven by AI, improvements in productivity, has really been seeing the US economy outperforming significantly. That said, as the Fed starts to cut rates, potentially before the Bank of Canada, that can see the dollar CAD start to move back lower. So again, another reason why we expect to see the US dollar weaker throughout the course of this year. Initially, as we say, US dollar stronger as interest rates stay higher for longer. But if we do see the Fed cut first, that's when we expect to see US dollar weakness. So that's what we wanted to cover today. As we mentioned, FX markets have been remarkably quiet to start the year. Historically, low volatility periods don't last. Something happens that drives a big moves in markets. So that's certainly what we're prepared for. We think what's most likely to be the driver of volatility will be that divergence in central banks. If the Federal Reserve cuts first, then that can see the US dollar weaker, and we could see a bit of a short-term spike in the pound, in the euro, in the Aussie dollar. If we then see those central banks cut rates, and that's when they start to move back lower. So you can see what might drive some of that volatility into the first half of this year. In the back half of this year, of course, the risk will be the US presidential election. And we already showed you right at the start how geopolitical uncertainty has picked up, and that continues to be a big risk going forward. So what we're looking to do here at Convera to help our customers is really in a couple of ways, but certainly, in terms of how we can help businesses with currency volatility. What if we continue to see, material 5 to 10% shifts in key exchange rates? Well, talk to us about our full range of currency risk management tools. Geopolitics. What is your industry? What if your industry or specific country of interest remains exposed to supply chain risks? We saw over the last 3 or 4 years how that can have a seismic impact on your business. Well, we can help with our trade solutions and help organizations accelerate payment speed or diversify into alternative markets. And of course, sanctions as well, something that we've got real expertise in. And it's Convera's long pedigree of helping businesses manage the complexity of international payments. Our size, our relationships with banks and regulators, our understanding of the compliance landscape that really sets us apart in terms of being a partner on payments and foreign exchange and commercial payments. So certainly speak to your Convera representative if you need more information about this. I'd like to thank you from all the Market Insights team here, and a special thank you to Shirley for presenting today. You can see the QR code there at the bottom of the screen. Please use that. That will take you to our survey. We're really keen obviously to get your feedback about what you think of the webinar, but particularly about what you are looking for us to cover. The only reason we do this, through these webinars, is to help our customers, to provide them with up-to-date information. And so if we can find out what's really important to you, we can tailor this content to make sure that is even more relevant. So as I said, just there at the bottom of the page, you can see the survey. And if you take a photo, well, you don't take a photo, but you point your camera at that. I'm sure you all know how to use QR codes, but if you, we'd really appreciate if you took the time to give that feedback and to provide us an update with what you're looking to see. Once again, just want to say thank you very much for everyone for attending. Don't forget that the what we've presented today is part of the Global FX Outlook document. So we've got a whole lot of forecast scenarios and ranges in the document as well. You don't need to take a screenshot of these. They're all in the document. So as I said, it's in the resources section of the Zoom controller. So please make sure that you download the report and check on the blog regularly for updates. I'd like to thank you again. My name is Steve Dooley. I'm the Head of Market Insights here at Convera. Thank you for your time. Really appreciate you coming and look forward to seeing you. Remember, these events, we hold them each week, each month, the first week of the month. Look forward to seeing you in April. Thanks, everyone. Bye-bye.